Buildmax is an interesting stock. I remember it for years ago when the Malaysians came into South Africa and acquired a controlling interest. Share price actually got to 90 Rand in the 2007 boom. It's around 2.80 Rand at the moment, a very different company, and a company that is worth starting to look at. Last year, that's 2013, they improved dramatically. This year's most recent set of financial results, it's a pleasing growth, 15% now, more normalized. They do have some interesting operations in other parts of Africa, having moved recently into Botswana. Should you be buying the shares? You could do worse. You could do worse. If we do see an uptick in the commodities cycle, then certainly this is a stock that could improve from its current levels. It certainly is not on a demanding valuation. And all round, it looks like the management team have got themselves together quite nicely. So it's not one of those that you're going to find in too many institutional portfolios, but for private clients, not a bad idea. So put Buildmax onto your list of companies to look at. There's lots of information on the website. I'm very impressed by the professional way that they've done their annual report, and with people like Bulelani and Luka involved there as well, they've got the right credentials. Have a look at this one.
The past financial year of Buildmax was reasonably good, taking into account the circumstances of the industry that we work in. The sectors that we work in, being contract mining, contract civils and quarries, have been quite hard hit by the general downturn in mining, the challenges in that industry relating to labour and commodity prices. Having said that, though, Buildmax came out through the year reasonably well. We had a growth in turnover of around about 7%, and our profits went up by 19%, and our headline earnings went up by 15%. Coupled with that, we've managed to reduce our debt significantly. Our net debt is down to 271 million Rand, which is significantly down from what it was last year. So all the signals bode well. Our balance sheet is strong. We had over 90 million Rand in cash on the balance sheet. So we're feeling reasonably robust at the end of the financial year. Our tangible net asset value has gone up by 13%, and we still trade at a significant discount to that. And we feel very strongly that our tangible net asset value is real, in that we have a relatively conservative depreciation policy on our plant assets, and this is displayed by the fact that when we sell assets, we generally make a very small profit or break even on those assets on an annual basis. So we're feeling very optimistic that with our modern plant fleet, we're going to be well positioned for the future. The prospects which relate to the forthcoming financial year, it goes without saying that it's going to be tough in the sectors that we operate in. There's still ongoing unrest, especially in the Platinum Belt in terms of labour. The labour challenges emanate right through the industry. Having said that, we enjoy a 5-year wage agreement with our chosen union, and we have a solid working relationship with them, which we work on every day of our lives. It's treasured by us. We believe that relationship is one of our key differentials in the industry, and we continuously strive to make sure that we have a better relationship with all our staff and our other stakeholders. And we think that will leverage us into good prospects for the next financial year. Over and above that, going back to our plant assets, we've spent a lot of money in the last 3 to 4 years on replacing our plant, and we have a philosophy that says that we will replace plant every year, and we have a robust replacement strategy in place, coupled with a maintenance strategy. So our plant is in really good shape, and to the extent that only less than 2%, in fact, of our plant assets have over 20,000 hours on them. So if you couple that to the useful life, we're sitting at around about 40% of the useful life of our plant on average. One of the situations that has faced our industry is that aging plant has been tried to be extended, and we recommend that and believe that you need to replace plant assets every year on an annual basis. So what we've done to facilitate that is that we've made sure that we pay down our assets over 3 years, in most cases with the banks, which gives the banks confidence that have always got equity in the assets that are financed by themselves. So typically what we do is we'll pay off 50% of the value of the asset in the first year, and then 30% and then 20% in the final year. So that conservative approach does hit your cash flow to a degree, but it positions you well for getting future bank finance, which we haven't had a problem getting to enjoy our growth strategy going forward. Part of our strategy has always been to diversify from our reliance on coal assets to other countries in other commodities. And we're very pleased with our successes in that regard. In the past 12 to 18 months, we landed a contract in the Congo, the Republic of Congo, with DMC, and that started off and went well, and however it's been put on suspension for the meantime, but we're still there at very low risk. We also landed a contract in Botswana, which has just started right at the tail end of the last 2014 financial year, and we'll get the full benefit of that during the 2015 financial year. And that is going particularly well with a new client in the copper industry, which is great. So we're diversifying out of coal into copper, and in the Congo we're diversifying out of coal into iron ore, which is also great. We're also looking at some opportunities in other countries such as Mozambique, and we're feeling very confident our ability to grow into those countries quite soon. Having said that, though, we still believe strongly that our core business in coal has got legs and that it will continue to prosper in the years to come. Eskom has got an inherent demand for coal, and the use of contractors in extracting that coal, we believe, is going to have a propensity to grow due to the fact that most mining houses need that flexibility by using contractors. They like the fact that we do a good job for them alongside our obviously robust competitors, but the use of contractors have generally been able to outperform the mine owners doing the work themselves. So we feel very confident about that. I think one of the big factors facing the industry is the liquidity crunch and the banks being conservative with lending. Having said that, we believe and feel confident of our ability to get bank funding to help us grow into the future. We believe in our strategy that we're going to be able to diversify into other commodities, not only in South Africa but in other countries. We have an ambition to get into the coal sector in South Africa. We have an ambition to get into platinum, and then I think we are really nicely spread. Currently, our spread is still concentrated in that we have 68% of our business in South Africa, about 6% outside of South Africa, and the balance of our business is 11% on our civils business, and the balancing number is 15% on our quarries. So we're pretty much feeling very confident about the future, to the extent that we are operating in a very tough environment, and that those challenges will remain for the next 12 to 18 months.